Good afternoon, everybody, and welcome to Gray and Gray's Survive and Thrive webinar. I welcome all of you from different parts of the United States. I also welcome some of our clients that I see are online today as well. Just a little introduction before we begin. My name is Mark Kashgegian. I am a partner at Gray and Gray, and I do work within the McDonald's niche that we have. Currently, we have about 85 owner-operators, and that's from coast to coast in various regions. I've been working with McDonald's owner-operators ever since I graduated college 31 years ago. It's all I've ever done. So I feel as though I really have grown to know the brand and know the business well, and enjoy any opportunity that I have to help educate the owner-operators when it comes to financial issues and matters. So having said that, again, I welcome you all. What we've done is we've tried to identify 20 different ways to help owner-operators face the challenges they have today in the business. We have owner-operators that are small. We consider 1 to 3 store owner-operators. We have owner-operators that have 10+ stores. But today, and especially in the business today, we really focus on the smaller owner-operators, because the challenges that everybody face seem to be magnified with regard to the smaller owner-operators. So having said that, let's begin. There's a picture of me, but that's not important. What's really important is the challenges that face us today as owner-operators and as business owners and entrepreneurs. So I've identified 4 areas that we're going to discuss today. One being cash flow, and we'll talk a lot about that. Obviously, one being taxes. These are challenges that we face. Another challenge is achieving, sustaining, and exceeding financial viability standards. We all know what those are. For those of you that frequent FFS frequently, I'm sure you see your ratios and you see your viability point totals. We'll talk a little bit about that. And then we'll touch upon some of the external factors that I've identified here, like national health care, minimum wage, the economic decline that we've seen over the last 18 to 24 months. Commodity pressures seem to always be there, and other P&L type issues. The best way to predict the future is to invent it, and this is where I like owner-operators and entrepreneurs and business owners in all aspects of their business to take charge of their business. And how do we do that? We engage ourselves in business planning. As an owner-operator and a business owner, whether you have 1, 2, 3 stores or 10, you have a multi-million-dollar business. You employ tens of hundreds of people. You sell food to thousands of people every day. It's almost imperative that you have a sound business plan, and that plan makes sense for your organization, because that's how you will achieve financial success at the end of the day. So let's begin. Maintaining strong cash management. What do I mean when I say that? Basically, you know, whether you're a small owner-operator or a large owner-operator, it's very important to understand what cash management is all about. I actually have owner-operators that we've designed Excel spreadsheets for. They've actually designed them themselves as well, where they can track on a day-to-day basis how much cash is going to come into their business based on store deposits. And they pull that information from historical data from the previous year. So they may take a calendar, for instance, with 30 or 31 days and be able to say on the first day of the month, this organization is going to take in $52,000 of cash. On the second day, it's going to take in 56, and the third day, 58, and on and on and on. They also track on that same calendar the outflows of cash. So they know that on the first of the month, certain things are going to be drafted. They know that on the 15th of the month, it's possible that their banknote will be drafted. So they have a good fix day-to-day of the cash inflows and outflows, so that they can pretty much manage when to pay certain bills. That's what we consider cash management. Again, you can do it as simply as that. You can also create an Excel spreadsheet. We have Excel spreadsheets that we've created as well for owner-operators that are really looking to hone into really manage their cash well. So maintaining strong cash management is essential. Cash is huge. When I was in accounting school many years ago, I remember my professor said cash is king. Cash is king. Almost every single webinar or any presentation I make in a McDonald's venue, I'm always talking about cash is king. It's so important that we manage cash properly. Monitoring cash flow diligently. So understanding the differences between store operating income or net income and cash flow, understanding that those are two different things. Net income necessarily doesn't mean that's the amount of cash that your business generated. How do we get from net income to cash flow? We add back non-cash items such as depreciation, interest, expense, amortization, and things like that. But it's understanding what your cash flow is and actually monitoring it. One of the ways you can do that is you can log on to FFS. If you go to your ratio sheet or if you go to your trailing 12-month P&L, there's so many different places where you'll see your trailing 12-month pre-debt cash flow. That's basically the cash that your business is generating. Monitor that on a regular basis. One of the other things that we do, and I talk a little bit about that in item number 4, is we've also set up budget to actual worksheets so that owner-operators can use this sheet to basically budget what they think their store's performance is going to be for the year and then plug in month to month the actual results, thus showing the variance between budget to actual. That tracking and monitoring that variance is essential to financial success, because think about it. If after 4 or 5 months we see that budget to actual, our cash flow is down $25,000, we have to be able to make adjustments to make up for that shortfall. Otherwise, we can find ourselves in trouble at the end of the year. Number 3, budgeting a reserve to build cash. A lot of our owner-operators do this in different ways. Sometimes an owner-operator, because of estimated tax payments and real estate tax payments and personal property tax payments, when they come up, they can be a cash drain on the business. They actually set money aside each month, and they set up a special account. In some cases, you can call it a tax account, and that account's on the books and records of the business. But they set money aside and deposit it into that account so that when those big payments come due, the cash is there. Other owner-operators will set up what they call a rainy day fund. They may peel off, and within the business, they may peel off $200, $300, $400, $500 a month per store, put it into another account that's on the books and records of the business for a rainy day fund. What am I talking about when I talk about rainy day? I'm talking about normal reinvestment, ongoing reinvestment needs, things that just pop up. Another good cash management technique. Some owner-operators peel money off and invest it personally. Obviously, we take draw from the business to live on. We also take draw to pay our taxes. But some owner-operators are peeling off, if they can, and if their business allows, and if there's definitely excess cash to be able to do that, peeling off cash and putting it into an investment account, most likely sometimes on the books and records of the business. So there's lots of different ways to budget and build a reserve, and I think that's really important when we talk about cash management. So that may be one of the things you may want to think about. Forecasting monthly to ensure expenses and planned reinvestment are aligned with sales forecasts. This is so important. When we talk about business planning, this is what it's all about. You know, a lot of times now McDonald's owner-operators are engaged in what we call normal and ongoing reinvestment, and we also have owner-operators from time to time that are engaged in major reinvestment projects like MRPs and rebuilds and reloads. It's so important to look at each one of these projects. But more importantly, I just want to say it's also important to understand what those reinvestment needs are for each one of your restaurants. Each region has what we call a vision plan meeting, sometimes once or twice a year. And what they do in those vision plan meetings is they look at all of the stores in the region independent of who owns them. So they look at the store, they look at the demographics of the store, they look at the age of the store, they look at the reinvestment needs of the store, and they make a decision as to when they would either like to see that store MRP'd or rebuilt. It's very important. Most of the regions now are out communicating that information to the owner-operators, but if your region isn't doing that, it's important that you get that information from your regions, because as you begin to develop a business plan, certainly a financial business plan, it's really important to understand what those planned reinvestment projects are. And are they aligned not only with our sales forecast, but are they aligned with our overall business plan? Many times we will assist and accompany McDonald's owner-operators in meetings at the regions when discussing upcoming reinvestment projects. But in order to have a good discussion, you need to create a plan to see if those reinvestment projects make sense for your organization. Many times they may not. McDonald's may say we need to do a rebuild or a relo or an MRP in this store in 2017. When doing an overall plan, it may not make sense to do that project until 2019, when some additional debt is going to retire. So it's really, really important to understand this information so that you can incorporate it into an overall plan. Be leaner, cost-effective, and efficient. Can't stress that more. Whenever we can, we look at repairs instead of replacing equipment. Sometimes it may not make sense to repair. It may make better sense to replace it. We don't like to put bad money into something, right? But in a lot of cases, putting a Band-Aid on something or repairing something, especially when cash is lean, it may make more sense to do that. So you want to look at those options. Whether something is really a necessity or a luxury when it comes to your restaurants, again, you really need to weigh the pluses and minuses of doing certain things. What's going to drive capacity? What's going to bring in additional revenues? That's really what you got to look at. So when looking at some of these things, you really need to figure out what makes the most sense for my business. Utilities, food and paper costs, ops supplies, and other P&L items. I direct you, in this case, I direct you to McDonald's website, to the profitability website. There's some great tools on that website that talk about controlling utilities, food and paper costs, and other P&L line items. Again, access MCD on the profitability website. There's some great information there. Other things that some of our owner-operators do, and I think I'll probably talk about it in a few minutes, but I'll mention it now, is they get involved in bonus programs with their management teams to help reduce costs and drive profitability in their restaurants. And I do say caution, don't skimp on service and quality by being understaffed. You know, one of the big line items in our P&Ls right now, one of the things that we're seeing across the board when we look at P&Ls is an increase in labor. And we know that McDonald's has been talking about staffing for the peak and increasing labor and all those types of programs that are out there. Granted, a lot of times we try to be lean, we try to be a little bit more cost effective, but service and quality is huge in our business. It really, really is. So we have to be very careful. We have to balance that out accordingly. Separate the nice to do from the have to do and eliminate non-essential expenses and reinvestment. Again, what I'm trying to say here is we need to be smart in all the decisions we make, whether it's with a landscaping company that's going to be providing landscaping services for our organization, to somebody that's going to be doing snow plowing if we have a store that experiences snow in the wintertime, to some of those essential reinvestment projects that I talked about earlier. We really need to figure out, do we have to do this, or is this something that would be nice to do? When we're running lean with cash and things are tight, we really need to project and we need to manage cash properly. And again, in number 7, I say this, and I'm very strong about this too, consider delaying reinvestment if no foreseeable gains will come from it. Again, you need to incorporate these things. If for some reason you're an owner-operator and you already are saddled with a lot of debt because you had 1 or 2 other major reinvestment projects done in the last 1 or 2 years, and the third one is just going to cripple your organization even further. You got to develop that as part of your plan, and you need to communicate that with the finance teams in your region. Build that team, that finance team of a CPA that understands your business, and the finance director or finance manager, so that you can have a good understanding of what your plan's going to look like going forward. This one's big. Strengthen banking relationships and consider restructuring debt. We have an owner-operator right now, two-store owner-operator, we were talking to, and after looking at their debt summary and looking at their loans, we suggested this two-store owner-operator restructure their debt. McDonald's and the banks have some creative restructuring programs and refinancing programs that you may want to consider. Talk to your finance people, talk to your CPA. But anyway, this client happened to restructure their debt, is saving $7,100 a month in loan payments. That's over $85,000 a year in additional cash flow. This owner-operator had a cash flow coverage ratio that was dragging down their overall point total. So this restructuring now brought that owner-operator from 4 points to 6 points. So there's lots of things that we can do in our organization to bring us to a place that we want to be. As I just mentioned, surround yourself with financial advisors and people who understand your business and that can help you to create sound financial business plans. And like I said earlier, communicate these plans with the finance team in your regions. This is this is vitally important. It's very, very important that if you don't have a financial business plan that at least extends out for 5 years, you need to create one, and you need to go to your CPA and your financial advisor and help them, or let them help you to put that plan together. McDonald's has a 5-year planning tool on FFS. If you haven't seen it, you should go on. You should work that tool. You can work it with your CPA. Your CPA can do it. At a minimum, you should have a 5-year plan, and at a maximum, 10 to 15 years, and we'll talk about that a little bit later in this presentation. Understand your financial viability and all the metrics that can positively and negatively impact it. Know your point total and how you can reach, sustain, and surpass 6 points, and understand what your financial sensitivity is. This is so important. This is a big area, an area that creates a lot of stress for owner-operators. I ask you, do you actually regularly log on to WebFFS to review your financial standing? If you don't, you should. I know for our clients, we look at that every month, and we actually print out that cover page that shows the ratios and the point total and include it in their monthly package. We also trend their numbers from month to month, so we actually can see if an owner-operator is going from 8 points to 6 to 5 to 4, or if they're going from 2 to 3 to 5 to 8. So it's very important to track those things. Know your point total. Have a good understanding of what it means. The components of that point total: cash flow coverage, working capital, trailing 12-month liability turnover in days, and equity. It's very important to understand those. But even more importantly, within each one of those ratios, you should understand what the impact is. Okay, there's certain things that you can do in your organization that positively and negatively impact those ratios. For instance, drawing money out of the business negatively impacts your cash flow coverage ratio. So we actually have developed a sheet. We've shown it on past webinars, and we have it at ROAs to hand out. But it's a sheet that looks at each one of these ratios and looks at the different types of transactions and things you do in your business, and actually how they affect each one of these ratios. So it's good to have that understanding. Do you actually know what your financial sensitivity is for any one particular month? Financial sensitivity means if you're 4 points, let's say, for instance, right now, what dollar amount do you need to get to 6 points? That could be anything from profitability to a reduction in debt service to a reduction in draw to a reduction in G&A. to increases in current assets or current liabilities, what is that dollar amount that could positively affect your financial standing to bring you to a 6? It's very important to know that financial sensitivity. Do you understand what contribution margin is? That's a big one. If you go onto FFS and you look at your trailing 12-month P&L, at the bottom of that P&L you'll see your contribution margin. A contribution margin measures your revenues to your variable and fixed expenses, but more importantly it tells you or it indicates, it's an indicator of profitability of your restaurant. Back in the day, 2009, 2008, 2007, we were seeing contribution margins of 25 to 32% per store. Obviously, the higher the contribution margin, the more profitable the store is. Right now, we're seeing between 20 and 25% contribution margins. So you should know what your contribution margins are, and for each one of your restaurants. Also, understand how debt service affects your financial viability. On FFS, you have a debt summary schedule. That debt summary schedule shows everything you need to know about the loans that you have. Your accountants and CPAs should be tying that out every month to your balance sheet, but more importantly, it shows when your debt will retire, and it shows what your monthly payments are. So it's really important to understand and know those numbers and know how increasing debt service can actually have a negative impact on your financial standing. Quintile reports. Again, these are great reports. The CPAs don't have access to those right now. We're being told that at some point in time we will have access to those. Currently we don't, but as owner-operators you do. It's a stratification report, and it looks at pre-debt cash flow for your organization, and it compares your organization and your restaurants to other restaurants in your region. It's a great report. I think there's a lot of good information in there. I know that owner-operators give us access to them occasionally, and we can actually decipher some trends and some things that are important to know. So understanding your viability in all of these components is really, really important in achieving financial success. Maximizing all tax strategies. You know, this one is key. Tax planning is something that takes place all year long. I hope that the first time that you're hearing about your taxes isn't when you get your tax return on April 15th. You know, I'm hoping that at a minimum you're hearing about that at year end, but even more importantly, you're hearing about it throughout the year. You know, there are opportunities for us. There's accelerated depreciation. Owner-operators have benefited with accelerated depreciation, job credits, or employee work credits, empowerment zone credits, estimated taxes and such. I'm going to talk a little bit about each one of these. Very important right now, all of the accelerated depreciation provisions that we were accustomed to taking in 2013 are no longer available to us. And I'm talking about Section 179 and bonus depreciation. We do have 179 available to us, but at a minimal level at $25,000. Bonus depreciation is no longer there for us. We don't know what's going to happen. I serve on the Tax Reform Working Committee with McDonald's Corporation. We have conference calls every quarter. I know that McDonald's legislative team in Washington is monitoring this closely. I know our tax department's monitoring this closely. We don't know what's going to happen with accelerated depreciation. We're hoping that come election time in November or sometime between then and the end of the year, we'll have a better indication of what's going to happen, and that some of these accelerated provisions are reinstated effective 1/1/14. We don't know that right now, so it makes it extremely difficult for us to plan. But those opportunities hopefully will be available. Same with jobs credits, empowerment zones. You may have stores in some of the cities or inner cities in America. Very important to talk to your CPA and your financial advisors to see if in fact your stores qualify for empowerment zone credits. Estimated taxes. This is a big one. because estimated taxes are paid through your business and they come out through draw. And we know that as we increase draw, we negatively impact our cash flow coverage ratio, and thus it could be impacting our financial viability. It's really important that with estimated taxes, the government says that we have to pay 110% of our prior year's tax liability, and we make those payments in equal installments throughout the year. Well, you know, it's important to engage in conversations with your CPA and your tax advisors that if you have a major reinvestment project, let's say, coming up in the next year, or there's going to be a major road construction project that's going to have a negative impact on one of your stores, you really need to see what's coming down the pike for next year's tax revenues, taxable income. You may be wanting to adjust those estimates so that you're not outlaying that cash throughout the year, impacting your ratios, and then getting a big refund at the end of the following tax year filing. So looking at tax estimates, talking to your tax advisors, it's very important. The other thing is we have a lot of businesses that are seasonal, and most of the income is earned in the summer months. You know, the government allows to file a form where you can annualize your income and thus pay estimated taxes based on that annualized income. So again, there are opportunities from a cash point of view, you know, when looking at estimated taxes, to make sure that you're not taking cash out of your business that you could actually be leaving in there. So it's very, very important. Depreciation planning. A lot of times in previous years, I know we've acquired some clients where all the depreciation, all the accelerated depreciation available to them was all taken in 1 year. Well, in some instances that may make sense, but in some instances it may not. And you really need to have the discussion with your tax advisor about whether or not it makes sense to take all that depreciation in 1 year or to save it for future years if we know that taxable income is going to be higher or taxed at higher rates. So these are the types of questions that you need to look at. Even your organization's entity structure. Is it the right structure for your organization? And is that structure and that entity able to help you to minimize your taxes, or even maybe your exposure to self-employment taxes? So within the tax thing, there's a lot there, and I don't want to turn it into a tax seminar, but very, very important, be in close communication with your CPA and your tax advisor to make sure that you're maximizing strategies and minimizing your tax impact. Consider outsourcing and reducing costs, such as bill pay, bookkeeping, and payroll. We're finding now more and more of our owner-operators are looking to companies like ourselves. We have an outsourcing of back office and bill paying to do that. In a lot of cases, it's very cost-effective, especially if they have, you know, 1, 2, or 3 stores and they have somebody that's there paying bills. It may make more sense, and they can probably do it much more cost-efficiently to bring those and outsource those costs in-house to a firm like ours. There's other ways to outsource with payroll. A lot of owner-operators are doing their own payroll. Payroll's gotten very complicated. With national health care, it's going to get even more complicated. You may want to consider outsourcing that and using some of the payroll companies that really understand the McDonald's business. This one, honest communication with your employees, involve them in the plan. Loyal employees will help you achieve your goals. I can't stress this enough, and this is where I'm talking about a lot of our owner-operators now noticing have what we call management bonus programs, where in order to drive the plan, the business model, and to help increase profitability in the restaurants, a lot of these bonus programs are being put into place to incentivize managers and upper management in the organization to have better results. So it may be one thing you consider to help drive cash flow in your organization. Be flexible, adapt quickly. This one's huge. Again, with regard to budget to actual, when looking at financial results, you want to be able to adapt quickly to changes in your organization. Stay involved in your community. This one too is big. I mean, you want to understand what's coming down the line, especially with regard to business planning. Is there going to be any major road construction? Is there going to be any major retail building, new building taking place in your area? Is there going to be anything relating to the community and the store that your community is in? Very important as we look at putting business plans together. Keep in mind long-term retirement plans in mind. Diversification is key. Make sure your wealth is not all McDonald's. I got to tell you something. I will tell you this. In the last month and a half, I'm going to say since July 1st, I've received from maybe 6 different owner-operators a call asking me the question, what's my business worth, and will it generate enough income to last me through life expectancy? So in today's business, there are a lot of people, especially some of the smaller owner-operators, feeling the stress of all of these external forces that we're talking about, wanting to maybe entertain going through the exercise of does it make sense for me to sell my business? What will I generate in income, and will that help me to last through life expectancy? We're doing so many retirement projections right now in our firm, and I know that other CPA firms are doing it as well. But I got to tell you, it's a great exercise because it'll help you to determine when the right time to sell your restaurant is. I don't care if you're 47 years old or you're 67 years old, you should have a retirement plan. Whether it's I'm going to work in my restaurants until I drop dead, or I want to be able to enjoy my retirement, I want to enjoy my family, so at some point in time I'm going to want to sell my assets and retire and do something else. You should have a retirement plan. What does that entail? It entails a CPA like myself looking at your organization, coming up with a value of what we think your restaurants are. I just completed one 2 months ago for an owner-operator who had 7 restaurants. And this owner-operator said, I want to sell my restaurants in 2019. I want to be in the business for another 5 years. How much will my business be worth in 2019? So basically what we did is created an Excel spreadsheet that looks at pre-debt cash flow for each one of the restaurants right now. We had a discussion with the owner-operator. We talked about what the future reinvestment needs are, which certainly will impact value. We looked at almost 3 or 4 or 5 different areas that could impact value. We came up with a value. We applied today's tax rates. We also looked at what the debt would be in that organization at the end of 5 years from now to come up with a net cash upon selling that business. We took that net cash number. We talked to the owner-operator about what their other assets were, what their other liabilities were, and we incorporated all that data into a financial, retirement plan. And with that retirement, and we also asked questions such as, what lifestyle do you want to live? How much do you think you need to live before taxes through retirement? We take that data, we put it into our retirement projector, and in this case, this showed that the owner-operator could retire on the lifestyle they look to live by through the end of life expectancy. And it was a great exercise. And it brought a lot of comfort to that owner-operator. So as I said, we're doing a lot of that. It may be something you want to consider. It doesn't even mean whether or not you're in financial straits right now or if you're successful financially. It's something that you should do. You're creating a legacy. This is a business you've been in for many years. You want to be able to reap the benefits of that legacy you created. So I think retirement planning is very, very important. It doesn't matter the age. It doesn't matter your financial standing. It's just an exercise that you should be engaged in. The other thing I wanted to mention here is building wealth. You want to look at your portfolio away from McDonald's. You want to make sure that it's diversified. Have you updated your wills? If you have trusts or wills, are your beneficiaries correct? In a lot of, we just had a situation last year where there was a death in the family with an owner-operator, and the beneficiaries named in the will were not updated. And it turned into somewhat of a sticky situation. So you want to make sure that you do have a will. Your will is current, and all the beneficiaries incorporated in that will are the ones that you want to be beneficiaries. And also, if you have trust, you want to look at that as well. But you know, at the end goal here is to turn the golden arch, your golden arches, into your golden years. So the reason why I decided to do this this webinar today on this subject matter is that, again, I said we have owner-operators that are small, we have owner-operators that are much larger. But I'm very concerned for our owner-operators that are smaller, because some of those challenges that I identified early in the webinar, like cash flow and taxes and achieving, sustaining, and exceeding financial viability, and all those external factors such as national health care that's right on the horizon, right on our doorstep, and minimum wage, we know we're being pinched by that as well. It's really important that smaller owner-operators, especially ones that are having some financial problems, and they may be nothing other than doing significant reinvestment in their restaurants and taking on additional debt, it's very important to manage that process and to create business plans that are sound and that can take you not only from this year to next year, but out for the next 5-10 years. Very, very important. As we look at each month, we copy all of our WebFFS ratio reports for all of our clients. We plug it into a Excel spreadsheet, and we're looking at the trends, how our owner-operators are trending. And within their point totals, what are the components, what ratios are affecting that viability? So it's really important that you also are attuned to those trends, because that's what McDonald's is looking at as well. So it's really important to wrap your arms around all that stuff in order to survive and thrive in this business today. If anybody has any questions, there is a raise your hand button on your screen, and you can type in your question and I can take it at this time. But I also want to tell you that we have 3 more webinars coming up in the next 3 months. In September, we have our top 10 mid-year tax planning considerations. We think, we're being told that after Labor Day there may be more of an indication of what's going to happen on the tax landscape with regard to, specifically with regard to McDonald's owner-operators. So if we have updated information, we'll provide it at that planning webinar that we're going to do on the 16th. But we will have 10 mid-year tax planning considerations. It's important to tune into that because the year's not over, and so that you still have 4 months to maybe make some changes that will help minimize taxes in your organization. Then in October, we're going to talk about how to get to gold. And what we mean there is how to go from 6 points to 9 points and some of the things that you can do in your organization to help you to get there. And then in November, we're going to be talking about reinvestment planning, MRPs, reloads, and rebuilds, oh my. So some good stuff coming up over the course of the next 3 months. Again, that's my email address. If anybody has any questions, if anybody wants me to share with them any of the spreadsheets that I talked about during this presentation, feel free to reach out to me. Again, I've been doing this for 31 years, and what I'd love to do more than anything today is help educate the owner-operators and the system at large. It's a tough business out there today, but we can all survive. I believe that. I really do. As long as we plan, we put a plan together that makes sense, we can survive. I've sat in many meetings with McDonald's finance teams, QS CVPs, and GMs, and they love seeing owner-operators engaged in business planning. It's an entrepreneurial thing to do, so I encourage everybody to work with your CPAs, work with your financial advisors, and create those financial plans that carry us through. So again, thank you all so much for tuning in today. I promised to do this within 45 minutes, and I think we did. Look forward to seeing you in future webinars, and we will be at most of the ROAs this upcoming season. So feel free to reach out to us. We'd love to help out. Again, thank you very much, and at this point in time, it's a goodbye. Be well. Enjoy the rest of the summer. Thank you.